Thank you. Thanks everyone for joining us. This Financial Poise webinar, Structuring and Planning the M&A Transaction, is part of the Private Company M&A Bootcamp for 2025 series and is sponsored by Max Assets. Given that it's a bootcamp, attention, please. Slide 6 of the PowerPoint summarizes this episode, and slides 7 and 8 summarize the series. Speaking of the slides, we're not going to step through the PowerPoint in any kind of order, nor are you going to have to listen to us regurgitate any of the slides. This webinar, like all Financial Poise webinars, is an informal conversation about the subject matter. You can keep the PowerPoint handy if you wish. We may indicate which of the slides our conversation is touching upon as we proceed, or if you're old school and have printed it out, you can take notes on it if you wish. Our panelists are, and we are joined today by Bob Decker. Bob is a managing director at the Peakstone Group, located in Chicago, where he's responsible for transaction origination and execution with a primary focus on the food and beverage space. He is a career capital markets professional and operating executive with extensive experience working with companies ranging from emerging growth to large publicly traded companies. He specializes in developing and implementing creative capital formation strategies and advising clients on alternative approaches for maximizing shareholder value in connection with their M&A activities. We got Phil Buffington with us today. Phil is a partner in the banking and financial services team with Balch & Bingham LLP, which is a national law firm with offices in the Southeast and Washington, D.C. Bob advises financial institutions throughout the U.S. on federal and state banking laws and regulations. He's also a frequent speaker and presenter for CLE and other courses on topics related to bank regulatory matters, commercial lending, secure transactions, and banking topics. Winding out the dream team today is Michael Weiss. Michael is a principal of Weiss Burney, LLC, which is a boutique corporate and real estate transaction law firm in the Chicago metropolitan area. As a transactional legal veteran, Michael represents privately and publicly held entities in business and commercial transactions. He also handles the negotiation and closing of complex corporate and commercial real estate transactions, both domestically and internationally. He's also a certified public accountant, and his experience includes all aspects of mergers and acquisitions, securities, and corporate governance. I'm your moderator. I'm Robert London. I'm a partner at Jaspin, Schlesinger, and Narendran, which is a full-service law firm. We're about 60 lawyers, I think, in Garden City, New York, which is just a stone's throw from downtown New York City, Manhattan. I negotiate business transactions here on behalf of my clients, from M&A to executive compensation to asset-based lending to startups to anything that's fun to negotiate and difficult to draft, and vice versa. We appreciate that although you may be enthralled with our bios, you're not spending your time and money to hear our infomercials. Take a look at our bios at the back of the deck if you're really interested in us. This webinar is a production of Financial Poise. More about Financial Poise is contained in the PowerPoint. If you're attending the live premiere of this webinar, you can submit questions using your web portal. If you're watching this on demand or have any questions after the webinar, you can send an email to info@financialpoise.com. Please remember, the PowerPoint and conversation we're about to have are meant for general educational purposes and do not replace the need to consult with an attorney, an accountant, or other appropriate professional. In other words, if you are silly enough to take significant action based on what you hear today, don't come knocking on our doors if things don't work out the way you would have hoped for. All right, let's get this party started. So today we're talking about basically planning, initial steps, and structuring an M&A transaction. I'm going to start with a general question to the entire panel. Probably start with Michael in that regard, but let's talk very broadly, okay? What are the primary types of M&A transactions, and what are some of the key similarities, and how are they structurally different? Starting with Michael, I'll have him touch upon asset deals. Take it away, Michael.
Thank you, Robert. Good afternoon, good morning, or good afternoon, everyone. One of the main primary structures of a transaction, an M&A transaction, is, as Robert mentioned, an asset deal, and Bob and Phil will talk about stock deals and mergers. Asset deals are very simply a purchaser will acquire various assets of a target seller, um, entity, or non-entity, um, uh, and together with those assets, perhaps assume certain liabilities. We're going to get into the differences of why someone would do an asset deal versus a stock deal, the two major types of deals. But doing an asset transaction allows the buyer to pick and choose what they want to buy of a company and what they do not want to buy from a company from a buyer standpoint, and what liabilities they would like to assume or not assume. Whereas a stock deal which Phil will talk about in a moment, the buyer is really buying the whole ball of wax and buying the whole company. Asset deals have favorable tax reasons for buyers, which we'll get into. Um, but the reason asset deals are so popular is just giving the buyer the flexibility to just buy the assets it wants from a acquisition standpoint and not assume certain liabilities, especially contingent liabilities or any very popular in the industry where there may be um, that doesn't know it doesn't want. So the buyer will only assume certain liabilities of a seller and not assume others and leave those with the selling entity. Again, also favorable tax reasons. Asset deals are um, probably the majority of the transactions I handle from the buy side and the sell side, but not an overwhelming majority. Depending on the industry or the company, we'll also do a lot of stock deals. But the key thing to keep in mind for asset deals is a buyer is just buying certain assets, not the whole company, and not all the liabilities that go with that company.
Thanks a lot, Michael. I'm going to touch upon Bob now. Let's talk about when two companies combine. Tell us about a merger.
Sure. And I'll be brief here, Robert, but basically a merger is when two companies combine to form a single entity through an exchange of stock. And key considerations here typically are, is this a merger of equals? And in which case, if it is, which management team is going to survive the merger, or, will they combine the management teams? And in the instances of private transactions, how do you determine relative valuations of each of the companies? And that sets up the exchange rate. There's also a consideration. Sometimes there is what we call boot, or where cash is exchanged as part of that merger. And is that a component of that? And then last thing is, mergers have unique tax considerations, that could be very favorable for both entities that are combining. So those are some of the key issues.
I'm going to stick with Bob just for a little bit here, which is it's kind of easy in an asset deal. I stick with Bob for a little bit in an asset deal, that in a stock deal, which we're going to talk about a little bit, say, hey, there's a price and we have a purchase price adjustment mechanism. What happens in a merger where you've combined the companies or you have a contract, merger agreement to combine upon closing, but due diligence or post closing, there needs to be an adjustment to the value. How does that, I'll throw that out to the entire group. How does that get done? Is there a ratio that gets reset? Does someone have to put in cash? How does that happen? How should some of our people listen to this plan ahead if they ever think about negotiating a merger?
Yeah. With public companies, you typically will not have a reset.
Mhm.
And you have these resets, earnouts, adjustments, far less frequently with merger transactions than you would with, say, a purchase of stock or a purchase of assets. And Phil and Michael, I don't know if you want to weigh in on that. That's the investment banker perspective on that.
Yeah, I will weigh in and say, Robert, you raise an excellent point. And the mergers I've worked on of private companies, in my experience, have that problem in almost universly in every deal where there's, as Bob brought up, some element of boot because there's never initially an exact match or an exact thought. So often there is a mechanism that it will get adjusted based on earnings reported and so forth. So generally, and I'm oversimplifying it, in my experience, there has been drafted in an adjustment mechanism where one side will end up with more equity post-closing, especially with private companies, after a certain reporting and metrics are reported and measured. It's very difficult in a public company.
Yeah, right.
To do
Almost
that
impossible.
mechanism. Yeah.
I saw one recently where there was meaningful consideration in a merger situation that involved maybe 35 or 40% of the total consideration, all dependent on how a lawsuit turned out. And so there was this contingent consideration that was potentially paid to the non-surviving entity, if you will, even though you're technically both entities are surviving in the new entity. So,
All right, I need to hear from Phil. We haven't talked about stock purchases. Let's talk briefly about what's a stock purchase. What are some of the high level characterizations of a stock purchase and concerns?
Absolutely, Robert. One thing I'd like to point on back to the merger that Bob talked about a little bit. Even when you've got a merger of two entities, I know we've all had those transactions where there's certain assets and companies that are being merged. This could also be applicable in a stock purchase, but there's certain assets that the buyer doesn't want to end up with. So those assets are spun off prior to the transaction. They're either pushed out to a subsidiary or pushed out to the shareholder because the buyer ultimately doesn't want those assets. So I just wanted to mention that. But really, in the stock purchase, there are a lot of similarities to a merger. You end up with everything, all the liabilities, all the assets. From the buyer standpoint, that probably requires a lot more due diligence. No, not probably, it does. From the seller standpoint, not so much so, but they need to be prepared for the buyer to come in and review everything because you've got all the unknown liabilities that you'd have to deal with. You would have assets that you would have to deal with to try to make sure that they are assets that you want to purchase. But the biggest thing here is if you buy the stock, you're buying all the assets and you're assuming all the liabilities, known or unknown. So due diligence is a really key there. But again, from both parties' standpoint, it's a simpler transaction. There are no readjustment of licenses. You can keep operating that company exactly as it is as a subsidiary, and ultimately wait and see if you want to merge it into the buyer. So there are other options there. But the biggest thing is making sure you know what you're buying in a stock purchase, which would be very similar to know what you're buying in a merger.
Great. So we've touched on some of the concerns on each of the types for the most part. I'm now going to try to put it all into one salad here that Phil's going to chop up because we all like chopped salads these days. And Phil, can you kind of try to bundle what some of the main concerns and goals are that drive the structure of a transaction, so you kind of figure out which of these types of structures may be appropriate for you, given that that question could be answered in probably you could talk nonstop for a few days.
Well, absolutely. I mean, the whole panel here could talk about on this for an entire day. But I'll hit some of the biggest things that you want to look at that'll drive a structure. One would be overpaying for the target. I mean, the seller. You want to make sure that whatever the structure is, you don't end up overpaying or really undervaluing the structure from the standpoint of the seller too, because I'm not going to get into the tax planning of it, but the tax consequences of the structure you choose can have significant ramifications for both the buyer and the seller. Another big issue there would be hidden liabilities. Like we talked about in a merger and a stock purchase, you're going to have those hidden liabilities. So you got to make sure you do your due diligence. One of the biggest things that I run into in my M&A work in the financial institution side is, what are the economies of scale? What are the cost reduction am I going to achieve through the transaction? And if I want a 15% cost reduction across the board, the structure of a transaction can have a lot to do with that. Another issue that I think needs to be addressed is whether or not you get a stepped up basis in the assets. That can be very important for the purchaser. And quite frankly, how you structure the transaction is going to dictate that. And then finally, the post-merger integration, I think, also is a concern that you look at that drives the structure of a transaction, from whether or not it's an asset sale, a merger, or a stock purchase where you would continue to operate it as a subsidiary. And those are some of the highlights.
All right, well, I'm going to add a little protein to our chopped salad, just a general toss up to the group, which is, let's pretend we're on the seller side. From the seller's concerns, are there any changes to structure or thoughts that you may view differently depending on whether you're selling to a synergistic buyer or to a financial buyer, like, a buyout shop? Would anything sort of change your mind or raise some concerns or things you would look at differently?
I'll jump in. I think the first consideration from a seller standpoint in structure is, net cash, I would say, and certainty of cash. How much in a privately held company or even a publicly held company or a private equity is, what will we net after taxes? And if the deal cannot be, for all sorts of reasons, 100% of a cash deal, if there's an earnout component or deferred money component, how certain am I as a seller that I am going to get my money? And 50%, am I taking some paper? Am I taking some rollover equity? So I think there's all sorts of considerations, but to both what Bob said and Phil, it's generally an economic measure after tax, considering all sorts of factors where we can go on and on, that what's the best for the stakeholders of a seller. And sometimes that's not completely predictable, and there's other factors that figure into it, sort of timing. Do I need to sell? Is my industry changing? So there's, I don't know, 20, 30 multiple drivers where tax and structure is really just one of them. And therefore, a lot of advisors have to be involved, lawyers, tax people, to advise the sell side as to what to do it. But every component, I would say, Robert, really has to be looked at. Taxes for certain entities, based on their history or their balance sheet, are not as big of an issue as other economic factors, and vice versa, depending on the circumstances. So
Yeah.
if it sounds like a
you.
mishmash, it is.
So I'm going to stick with you, Michael, given that you're perhaps closest to a tax expert as we have on the panel here. Can you talk about some, high level concerns on tax efficiency, both goals and pitfalls that infiltrate all general structures, and as if and when they need to be considered in any transaction?
Yes. And from a high level, I'd like to say, a couple things. And again, both on the buy side and the sell side, please get your tax advisors involved, as early and often as possible, because sort of down the line, and I know that Phil and Bob have been involved in transactions like this, because I have, where you're at the 20-yard line, the other way, and tax issues are coming up, and people are trying to renegotiate or figure out the deal, and it sometimes is too late or too complicated. Um, the both sides want tax efficiency and want to maximize. A sell side wants to pay minimal tax, of course, and the buy side wants to maximize deductions. So what that usually means in its simplest form is, especially with a private company, is a seller wants to sell stock because the taxation on the sale of stock, capital gains, is lower than ordinary income, which ordinary income often figures into an asset deal. And there's all sorts of exceptions and corollaries to what we're saying, but we're talking general terms. So the seller wants to sell stock, and a buyer wants to buy as many depreciable assets as possible, so it can write off and take deductions against the purchase price of bonus depreciation, 100% depreciation, so forth. Again, there's all sorts of different types of assets and structures, but those are sort of the guiding principles. And now there are some things, I know some of the viewers may be saying, oh, there's 1202 stock and all these different changes and rates. That's true. So again, each company has to be looked at line by line to figure out what is best. And what type of entity is also very important. In the old days, as Bob and Phil will remember, you never wanted a buyer to generally, for many closely held companies, be a C corporation. Well, times have changed, and the last couple tax acts have built in some incentives on 1202, qualified small business stock, and the rates, where now there's different exemptions for selling stock in C corporations. So the entity comes into play, the type of deal comes into play, tax-free reorgs come into play. And unfortunately, I realize I'm raising more questions in 5 minutes than answering more questions, but there's just a whole checklist of issues to go through when looking at tax. So look at tax in a transaction early, right off the bat. But it's really hard to just generalize which way to go, other than everybody wants to maximize after tax dollars.
Great. So we
Robert?
talked, go ahead.
Just for a second, I agree with everything Michael said, but one point I wanted to point out in there too is a lot of these issues from a tax standpoint, if you're in negotiations to sell a business or to buy a business, and you're starting to try to tax plan for that within that 6-month to 9-month window, you really have done yourself a disservice. If you think you're going to sell, you need to be talking to somebody early. You need to do planning early, involving whether or not maybe you need to go to a S corporation if you're small. Maybe you need to convert to us. You need to look at these issues from a timing standpoint, so you're not confronted with an issue. I wish I'd known this a year ago, because I could have made these adjustments. And so that's the only point I'd add, Michael.
Oh, I think that's a great point, Phil. And I think we've all been involved in transactions exactly to that, where you're selling a C corp or an S corp, and someone said, boy, 4 years ago or 3 years ago or 2 years ago, I could have switched this, I should have switched this, and now how do I do around it? And that goes to the whole M&A concept. I'm sure we'll talk about either today or in another session, that the M&A process should start well before the transaction or the preparation therefore.
I mean, I've had at least 2 or 3 times presented with letters of intent and sellers who think the deal's going to go very quickly, and they're S corps and they have a lot of depreciated assets, and then you ask them if they've done the analysis of what the deemed liquidation built-in gain's going to be, and they're like, "What is that?" And it basically, if they're lucky, it reprices the deal. If they're not lucky, it kills the deal. So yes, definitely talk to do the tax planning as early as you can. I'm going to skip around a little bit. We've done some high level stuff. We've talked about the various structures. We've talked about planning for taxes. Um, I'm going to tap Bob, ask him to address what are the steps that, let's stick with the sell side for now, should take at the very outset of the process, which is, okay, you have a smally, closely held family business. The next generation doesn't want to take it over. There is demand on the buy side for it across perhaps buyout shops and synergistic buyers. What are the steps that that type of seller should take at the outset of the sale process?
Okay. Well, we talked a little bit about the tax planning. I think the sellers in those situations also need to think about wealth planning too. What are they going to do with the proceeds of the sale of the property? But when you're first getting ready to sell the company, we advise making sure that your financial statements are in order, whether or not you have audited financials reviewed. There are different levels of that mean different things in terms of the validity of those statements. But today, it's almost de rigueur, that we advise sellers to bring in a quality of earnings specialist to review those statements and point out areas where a seller may not quite be aware of, but a buyer will zero in on certain things. And you're getting a report that breaks down every aspect of your financial statements, from the quality of your receivables and your inventory and how you're valuing that. Really important to do today. It started off in the old days where the buyers were doing this. Now typically the sellers are doing all of this up front. I would say in 90% of the transactions we're involved in, even in financings these days, the quality of earnings is key. The other things that the seller needs to do, they need to get ready to populate a data room, and it's going to have all the information about their company, from the corporate history, the bylaws, minutes of board meetings, those sorts of things, to details about customers, and specifics about operations. So there's a lot of pre-thinking that needs to go into this before you put all of this information in the data room. You need to make it very accessible for the buyer to be able to find the information that they need to evaluate. One other thing to think about is what role is senior management? What do they want to do going forward? Or the owner? Does the owner want to, sell and go off to the beach? Do they want to stick around for a while? Part of that is dictated by whether it's a strategic or a financial buyer. Strategic buyers are much more willing to let the management teams go away. If it's a financial buyer, particularly if they are making a platform investment, meaning this is the first of many investments in this particular space, they're going to want the management team to stick around and roll over a meaningful portion of their equity in the deal, 20, 30, sometimes 40% of the deal. So they get a second bite at the apple. So the sellers and the management team really need to decide, what role they want to play going forward. And then, once you've gone through some of those things, and while you're going through some of those things, you should hire a financial advisor, typically an investment banking firm. People look at the fees sometime and say, "Oh, well, that's crazy. I can't pay that." Trust me, in almost every instance, hiring an investment banker pays for itself in spades. And then finally, you need to have experienced M&A counsel, and everybody here, has that in spades. And there are lawyers who drive deals to the finish line, and then there are lawyers who put up roadblocks to getting deals done. So you want people who've been through this a lot. They may seem like they're charging more up front, but trust me, they will remove all the headaches. And at the end of the day, you'll be spending far less money, and you'll be in much better shape, even if you're, hiring the best and paying for that. So those are the things that we think about, helping the sellers think about.
All right, I'm gonna jump over to Phil and let's put on our buyer's hat for a second. Why might a buyer pursue an acquisition of an equity interest or do a merger instead of an asset deal? Just looking at it from the buyer's point of view.
Well, one of the reasons you would pursue a merger as opposed to an asset deal would be to keep all licenses in place. And because that's really important. When you start talking about, and this is the difference I like to tell people. When you're looking at buying a business, you can start a business or you can buy a business. If you start a business, you've got all the ramp up time before you really achieve any income. So if you buy a business and you price it right, you can start making money the day after you buy it. And part of that is what you've got in place, the licenses to run the business. If you've got any copyrights or trademarks or service marks, you've got management issues. So really from the standpoint of doing all of that, from opposed to an asset sale where you're going to have to transfer every asset involved. If it's an asset involved, real estate, personal property, that could include titling vehicles, everything. And quite frankly, just the cost and expense involved of an asset sale. Now, there are some pluses to the asset sale that you've got to weigh against all of this. And one of those is avoiding unknown liabilities. And one thing that I'll mention here that everybody needs to be aware of that'll come into play in any transaction is successor liability, which can come into play even in asset sales where you think you are avoiding unknown liabilities. But that's really beyond the scope of that. Just remember that term about successor liability and continuing a business that could come into play.
Great. All right, we've talked about structure, we've talked about types, we've talked about concerns. Let's talk about Jerry Maguire. Let's show us the money, Michael. Let's talk about the basic ways on how sellers get paid for their companies or for their businesses.
There is cash is king, cash is key is I think really the starting place, and it has been in my experience, where you know, from a seller standpoint, putting aside the tax issues for a second, you know, cash is certain, cash is non-contingent, but many times a seller will do a transaction other than cash for all sorts of reasons. One, you know, there's been some, I don't know, for example, up and down years or some events going on in the business where a seller is offered hypothetically a really good price, but some of it depends on a seller earning reaching certain metrics or milestones, what we like to call an earnout in the big term. And it's a seller basically saying, look, I'm willing to take a little risk, or maybe more than a little risk, meaning one, for something going forward, because I think the business is good. I think it's going to hit these metrics. So I will take, you know, 70% cash and 30% over 2 years. Could be a sliding scale of what that maybe that number will go, or that percentage will go up and down. There's also, you know, rollover equity, and maybe a seller says, I'm getting some cash, but I really think I want to take some chips off the table, but I really like where this buyer's going. I like the way they're thinking. I think they're perfect for my business these days, and I think they're going to grow, and they're offering me stock in this future organization, which can take, maybe it's a different organization, maybe it's just the company being purchased, but I'm willing again to take some chips off the table and roll the dice that we're going to work together. And that's popular, especially for Some sellers who don't necessarily want to retire, they want to keep going and want to keep working and want to build up a business, but they want to lock in what they've achieved to date. Cash is king, but then there's all sorts of deferred money, deferred growth opportunities out there for sellers. And that's sort of an overview from a seller standpoint. Now, I will mention a bit of a negative. Sometimes a seller will sell a business and a buyer, there'll be, a big holdback or a big contingency element of the purchase price if there's a big pending lawsuit or some other, warranty exposure liabilities, and the seller just feels like, hey, now it's time to sell, even though it's unclear what the value is of what I'm really selling. And then sometimes the seller will take, maybe not a lot of cash, and there's a little bit of a question is what will the final number be depending upon how certain events play out.
Great. So we've been focusing on the money. Let's stick with our now seller, and I'm going to ask Bob about what should a private company sell side be aware of at the early stages when selecting a financial advisor so it can do its best to get well-deserved purchase price, and what are some of the deal points when just looking at an arrangement with a financial advisor, or should they just simply sign whatever the financial advisor proffers them in their retention letter?
Well, as the only investment banker on the panel, of course they should just sign whatever the investment
Softball hit
banker
out of the
puts in front
park.
of
There
them.
it
But
is.
yeah, right. So listen, the investment banker, they're really responsible for structuring the process, identifying buyers, run an auction if that's the way you're going. But in terms of the steps, in getting engaged with a financial advisor, the first thing you need to do is get an NDA with the advisor, so they understand that everything's confidential that you're sharing with them, and that's pretty much expected by by all parties. So the next thing you do is you are structuring your financial advisory engagement, and there are a number of components to that, from a from a payment provision. They start off with retainers. They could be one-time retainers, monthly retainers. They can be non-credited. More often they are credited, either 100%, sometimes it's 50%, but there's typically some credit back for the retainers against any success fee that's at the back end. There are instances where you have a really strong company and they're able to negotiate purely a success fee, no retainer payments, but those are not typically mainstream. Most deals have retainer payments in there for the advisor. And then you look at things like tail provisions. How tail provision means that any parties introduced to the seller throughout the sale process, there will be, even after the engagement terminates, could be 12 to 24-month tail period when the seller is still going to owe if there's a deal done with one of those parties. You think about carve-outs. Have you talked to potential buyers prior to hiring the investment banker? A lot of times sellers want to make a different deal for parties that they've previously talked to or been introduced to. As an investment banker, we hate carve-outs. We'll typically work with some discount for people if they're pretty far along, but it really doesn't change the amount of work that the investment banker has to do. So that's always going to be a negotiating consideration. And then how do you calculate the success fee? Is it gross fees? Is it net fees? How do any escrows or holdbacks get paid? Is it do you agree up front what the expectation is on that and pay the banker, or do you wait until those are released and then the banker gets paid on those? And then other closing conditions, Obviously you always want to make sure that you tie the success fee to the actual closing of the transaction and not anything else. And just touching on a couple other things in the investment banking, engagement, expense reimbursements, you typically want to cap those or have pre-approval for any large, expenses that are out there. We always look at exclusivity period. Typically you only want to, or the investment banker only wants to they want to be the only one representing the company, so they're not stepping on the toes if there's another investment banker or broker. So that exclusivity period is important. And then what rights do you have to terminate the agreement? Is it for cause? Is it, in most of our agreements, we allow the seller to terminate at any time for any reason, basically with 7 days notice. And most sellers appreciate that. Now, what protects the investment banker on that is the tail period. So you can fire your investment banker, but if somebody does a deal in the next 12 months with one of those parties, you're still going to have to pay them. And then finally, you just want to make sure your advisor doesn't have any conflicts. Are they representing a competitor of yours at the same time? And so those are just some of the things that you need to get ironed out up front in your advisor agreement with your banker.
Given that I basically asked Bob to tell people how to negotiate against him or be aware of, I will chime in a little bit on expenses, which is, it didn't used to be this way a long time ago, but in most of the financial advisory retention agreements that I've seen lately, there's an upfront deposit towards expenses. So rather than having a provisions on pre-approval and stuff, you may have that, but separate from the retainer, which may or may not be credited towards a success fee, there is a prepaid expense provision so that the banker can set up the data room, that it can pay its people to do what it needs to do its diligence to best, market the company, rather than going piecemeal monthly billings as you go. Here's our receipts for travel. Here's what we paid, a printer on a special book that we prepared to send to certain investors. I've seen a lump sum upfront expense reimbursement deposit on top of any upfront success fee or banking fee.
Robert, I've never done that, but now that you bring it up, I'm gonna consider that. So
I would say of the last 6 or 7 financial advisory agreements that I've seen, the deposit has been upfront in 5.
And then you have to reconcile at the end and just demonstrate that those are true expenses, right?
Right. You don't get to go to Miami for the weekend, or you don't get to go to Pasadena for the weekend to go see Oasis because you think it's a good idea for the sell transaction. So, but you should go see Oasis.
Hey, Robert, Bob, I agree with what you're saying. One thing that I've seen, and I don't know if y'all run into it before, I've had clients come to me and they've already engaged an investment banker, and that's all fine and dandy. But what they didn't really consider when they were looking through it was the scope of the service to be provided, which you talked about, and the fees that would be paid based on that scope of service. And then you have the client come back to you and ask you to try to renegotiate a letter with their investment banker that they negotiated themselves. And you can clearly see that that's an issue that could have been addressed on the front end if they had thought about it. And it may just be, for example, like I used, if the buyer is trying to get you to exclude assets, but the investment banker believes that ought to be part of the consideration that's being paid, I don't disagree with that, but everybody should have been clear, and that's just the seller taking another bite at the apple at the end when it's something that should have been dealt with on the front. And I just think it's important for sellers in particular to understand the scope. And most investment bankers I've dealt with always explain that to them. It's purely a seller mistake. And if they had somebody else involved, they may have just said, this is what you need to think about. Go back and ask them about it. Just make sure you both understand what the deal is.
it's both the scope of what are you going to do for us, who are you going to market to, are you going to host the data room to, if I'm representing the sell side and you've given me the agreement to start, I'm going to say, hey, were you marketed by a key managing director? Is that person going to be your point of contact with all buyers and no one else? Like it can go, it can be micromanaged, and sometimes it's well worth it rather than getting a handshake, signing a deal, having the deal put off to some junior associate and it not being a priority for the banking firm. And now you're sort of locked into an indirect exclusive fee. So
Yeah, there has to
want
be a lot of trust. Has
Yeah.
to be a lot of trust involved in all of that. And uh, do your homework. Love it when people do their homework on us and at the end of the day come back and decide, hey, we've heard nothing but good things about you. So it's great.
I want to jump in just for a second, comment about Bob, sort of focusing on you here as the investment banker. Having been an M&A attorney for a long time, I've observed over the years, the role of the intermediaries and the investment bankers. And I think it's a lot more difficult, Bob, now than it was in the old days. The client expectations that I've felt are just so much more. I think in the old days, we sound like dinosaurs, sort of pre-information overload and internet. The investment banker would market the business to sort of 10 or 20, possible buyers. Now there are, an unlimited amount of private equities and strategics, and new private equities are sprouting up daily, literally daily. Oh, who is this private equity group? Oh, they just branched off from this group. I mean, you literally need a daily scorecard, and there's so much information out there that I just really believe that the investment banker job, Bob, is even more difficult now than
Well, here's what
ever.
we contend with, Michael. What we contend with is that there's always an outlier that the seller has looked at. Let's give an example. When Kellogg's inked their deal for RX bar, they were paying 10 times revenue. So that's the high water mark that everybody who has a bar business is looking at and saying, well, I deserve 10 times revenue for my bar business, with ignoring the fact that there have been 20 new entrants into the industry since that time. And the things we contend with are oftentimes the outliers that get a lot of publicity, and that's what sellers hang their hat on and what they think is the appropriate valuation for that. And what we as investment banker try to explain to people is it's our job to go clear the market for you, to figure out who's going to pay the highest price and be the best fit given all the considerations that you need. But it's not easy. You're right. It's a tough process, and you can spend a long time working on that process and end up not getting a deal done for reasons that have nothing to do with how you're executing that as an investment banker.
I call that, just last thing I'll say is, I call that the valuation disconnect.
Yeah.
And I see a lot of that.
Yep.
Well, and another thing you deal with, Bob, I mean, with so many new businesses, you deal with the issue of whether or not you've got an experienced buyer and seller or novices in the transaction, first-time transaction people. And quite frankly, the learning curve there is pretty significant. And with so many businesses growing so fast over the last few years, and having the availability to sell because the marketplace, I think it's important for people to understand that they need to know what they know and know when to ask questions about things that they don't know.
Yeah. Well,
And
we will typically do a deep dive on the buyer, and you can just tell by who they've hired as counsel, for example. Do these guys get it? And so those are important considerations, Phil. Absolutely.
Great. So the next topic's really not a structural issue, but it is part of the planning process, and as a key part of an M&A transaction. I'm going to tap Phil to sort of walk us through the due diligence process. basic items, and then maybe chime in and give us an example or two on how due diligence findings can affect integration planning, closing the deal even, and all the things that might pop up in due diligence, how it affects the planning and structuring a transaction.
Yeah, thanks, Robert. I mean, we've talked about a lot of this. I think the key is making sure that you've got an NDA in place, protecting the information, and then setting up a data room. I mean, everybody has those now. And so you've got to do that early on. But when you're looking at this, the sheer volume of information that can go into a data room depends on the type of transaction you have and who the parties are. But you've got corporate governance issues, and that's basically all the documentation for the corporation. You've got the financial data that needs to go in there, the accounting data that needs to go in there from the standpoint of both sheer from the taxation standpoint, but also from the operational standpoint. Then you've got legal due diligence that's in there. If there are any lawsuits involved or any potential lawsuits or any warranty claims or things like that that are out there. So the most important thing is making sure that you're providing all information. I know we've all been in transactions where the seller may call you and say, "Oh, I forgot to disclose this one agreement." Well, my answer to that always is, well, we need to immediately ship it out to everybody that needs to see it, especially if it's a long-term agreement. How did you miss it? It may be just a small contract, but it still could be material to the buyer. So I really think having the data room in place, like I said, covering the corporate governance type of information, the financial information, the legal information, and just the operational information is very important. Now, some of the biggest issues I see, and I tell people this on the front end all the time, don't leave personnel issues to the end of the transaction. I've had sellers or buyers, I've had buyers drop employment contracts on sellers 2 days before closing and had employees tell me, "Well, I'm not even going to have a chance to look at this." Well, you do have to look at it if that's a key part of the transaction. And quite frankly, that should never happen. I encourage people to deal with personnel issues early on and get them out of the way. Because really, if you're talking about who's getting what benefits and how the benefits are going to merge, who's going to stay, are there going to be retention agreements for a short period of time? Are there going to be change of control agreements? Are there going to be employment contracts? All of those things need to be worked out early on and not just days before closing, where the stress level will be higher, the anxiety will be higher, and quite frankly, it's going to lead to mass confusion, in my opinion. But I've had that happen more times than not, even though the parties are telling you we're talking about those and everything's okay. So that's one thing. The other is just not knowing. I had one transaction that we were closing, and I was dealing with the president. The shareholder who was the sole shareholder had died in the transaction. And unfortunately, he had a lot of institutional knowledge that went to his grave with it. One of those issues was his agreement to pay all employees their accumulated vacation and sick time in the event of a sale, which was pretty substantial. And this came up from the HR director just days before the closing, which almost killed the deal. But if the buyer had looked at that really hard to begin with, then we may have seen it. Now, quite frankly, my HR director should have disclosed that early in the transaction too. But it was something that, came up at the end that could be avoided with proper due diligence. And those are just simple questions you ask.
Those type of issues will probably come up in the next episode, which is key provisions, where we talk about how the representations and warranties work with the disclosure schedules on both the due diligence process, determining whether or not you're good to close, and post-closing indemnification. In our last few minutes, I'm going to ask Michael briefly to bring us through a very basic timeline of a transaction. What are the stages? How long we could expect it to take? And then I'll bring us on home and bid adieu.
All right, real quick in the last few minutes. Typical transaction, always exceptions, always twists and turns. And let's just say from the sell side, first thing I do is I hire Bob and I get my company out to market. Bob does a great job, and in 60 days finds the perfect buyer for my company. Then a buyer will and a seller will typically sign what's called a letter of intent, just a couple pages outlining the framework of the transaction. Just sort of ties people up to exclusivity and a good faith commitment, even though it's generally not binding, to close a transaction. Um, Due diligence is starting. The buyer, as Phil mentioned, very important, and we'll talk more about that in future sessions. The due diligence, a data room will be populated, and a buyer and his team of experts will start combing through the information to make sure that the purchase price they kind of guesstimated in the beginning is really accurate, and they still want to buy the business and want to buy it for that price. At some point, maybe earlier, maybe a little bit later, lawyers will start drafting the stock purchase agreement or the asset purchase agreement. Parties will all the time work through a lot of different issues, a lot of those Phil alluded to, employment issues, vacation pay issues, and the like. And I'm really bringing this home quick. I wish it was this quick in the real world. An agreement will get signed very often in the deals all of us work on. They're sign and close. The agreement is constantly being negotiated and document ping pong between the lawyers and the clients. But hopefully an agreement will be signed and a transaction will get closed and the provisions will get implemented. And then, the seller gets its consideration and the buyer gets the company. And all during the meantime, of course, any licensure consents, contractual consents is going on. So it's really a circus, but in sort of controlled chaos. And a closing, there was an old picture painting I think we've seen, but it's been a long time. Phil, you may have it in your office somewhere, Bob, of the closing table with different people in different sizes. And I've always sort of loved that. And as we know, it's controlled chaos, and then it's over, and everybody gets what they want. And I will say, in our last minute, in the old days, when we would close a deal, there'd be some sort of closing dinner or celebration. I don't know about you guys, but more often than not, people are just tired and sort of the fun. I used to love those closing dinners, or whether you're on the buy side or the sell side, everybody's happy right after a closing. But unfortunately, those have kind of gone away a little bit, but those were fun. I will
Oh,
still
for
say that
sure.
that's part of the closing process,
Used to be
though.
leather-bound volumes of the documents, and a best case scenario, no one would ever have to look at any of the agreements ever again. You might get a lucite cube memorializing the deal, or even a gift from the banker, Bob. No, but no more. Well, thanks. This has been a great one. Thanks to our sponsors, Max Asset. You can check them out on slide 3. You can join me on September 9 for episode 2 of the 2025 M&A Bootcamp. We're going to be talking about key provisions in M&A agreements. And until then, stay safe, and hope to catch you on the next one. Thanks, everyone, especially to
Thank
the
you.
panel. Great job.
Thank you.
Thank you.